Hello everyone, thank you so much for joining. I would like to introduce discounted cash flow. Very simple. We don't go into the detail, just want to give you an idea what the concept is and what our thinking behind this method is. So as we learned earlier, if we look at the income statement, we have revenue, gross profit, SG&A, EBITDA minus D&A, EBIT minus interest, EBT minus taxes, and then we have net income minus dividends, and then we have retained earnings. Yeah, and what we really want to do is, looking at DCF, calculate the discounted cash flow. When you talk about cash flow, it's the free cash flow. Free cash flow, it is free because that is the cash flow that is not reinvested, that is not used up in net working capital. I will explain net working capital later as well. So free cash flow, we are concerned with the free cash flow available to pay debt holders and to pay shareholders over time. Yeah, when we talk about free cash flow, it's the cash flow capacity. So we are not just using interest and dividends added up and say, okay, this is the cash flow available, because we look at many years in general. What is the free cash flow capacity of the company? We use this then to explain the value of a company, because in the end, everything that the company spends here, taxes and so on, that's all used up in the business operation. That's what the company needs to pay employees, to pay suppliers, to pay the government. It doesn't necessarily give us an indication of how much value a company generates. So under the free cash flow or discounted cash flow method, what we are looking is the cash flow the company generates. And what we usually do is, the main formula we are using for free cash flow, quite simple. We use EBIT times 1 minus T. We need to deduct taxes because taxes is not available, because this part is not available to pay money back to debt holders and shareholders, because you need to pay the government. So we need to deduct taxes. We start here with the EBIT line item. What we then do is we need to add back depreciation and amortization. This is a non-cash item. We just deduct this for tax purposes. There's no money that exchanges hands. So we add this back because the income statement for this particular item is a misrepresentation. So we add back D&A. And then what we do, we deduct CapEx minus CapEx and minus change in net working capital. Yeah, change in net working capital, I come to this. This is based on current assets, current liabilities, in particular accounts payables, accounts receivables and inventory, because you need a certain cash flow for timing gaps between when you pay your suppliers and when you receive cash from your customers. And also there's some value tied up in your inventory, which we will change here. And then also there is an amount of cash that you don't distribute to debt holders and shareholders, that you basically reinvest, which is the CapEx part, which we will discuss later. So what you do is you use this free cash flow formula, and you use this formula basically for every single year. So if you have an explicit forecast period of, let's say, 5 years. Then you calculate your free cash flow for every single year. We call this approach free cash flow to the firm, because here we start with EBIT 1 minus T. So in general, this is the free cash flow available to both debt holders and shareholders. What you then do is you calculate your free cash flow in every single year, and then you discount it. Yeah. Your discount factor is usually your weighted average cost of capital, which we will discuss later. So you discount it to get your present value of cash flows. And what you do is at the end of your explicit forecast period, because you don't want to do this forever, but you assume the company operates on an going concern basis, which means operates forever. What you then do is you calculate your terminal value, which is your free cash flow to the firm in year 5, times 1 plus a growth rate that you assume, divided by WACC minus your growth rate. This is your terminal value for your year 6. And then what you do is you again use your terminal value divided by WACC to go to present value. Yeah. If you have calculated your present value, let's say 100 million. Yeah. Once you have done this, this is basically your enterprise value. Yeah. Value of the firm. What you then need to do is to derive to an equity value is you take your EV minus net debt equals equity value, and yeah, that's it for now. I will explain more about WACC, about equity value, net debt, enterprise value. But just to give an idea what free cash flow is. Free cash flow idea, what capacity does a company have to pay debt holders and shareholders. You do this for every single year. You discount based on your weighted average cost of capital to calculate your equity value, your enterprise value, and then you do some net debt adjustments to derive to your equity value. Thank you so much. See you later.